Yes, that's quite an interesting question. I mean, obviously, we've seen the turmoil in the banking sector, and there is a concern that there will be a spillover to a broader financial system. As a result, we've seen pressure on the prices across many commodities. Oil prices moderated, base metals prices also came under pressure. However, the gold outperformed due to the flight to safety. If we just look at the oil market, then the supply and demand remains relatively balanced. So on the supply side, we do anticipate an increase by about 2 million barrels per day this year, and it's quite a substantial increase. Half of it will come from China because of the removal of the zero COVID policy. And as a result, we do anticipate the boost in air traffic. But then if you look at the supply side, then the Russian oil exports have held up relatively well despite the sanctions. And the country managed to reroute quite a few shipments to Asia. However, the Russian oil is sold at a very heavy discount. I think it generates estimated about $49 per barrel for the Urals. Then if you look at the OPEC plus spare capacity, it's over 3 million barrels per day. It's mainly from Saudi Arabia and Abu Dhabi. But then there is also the potential for the US oil production increase. So generally, the markets are relatively balanced, and obviously there was a reaction to the overall pressure on the commodities from the financial turmoil that we have seen.
Can I ask you about some of the hedging going on in the oil market? There are concerns that some of the banks were just closing off some of the positions given the sharp falls we saw on the back of the banking situation. To what extent are we just seeing speculation at this stage?
I think there is definitely a concern in the market about the potential spread to a wider economy from the banking shock. But I do believe that the pressure on the oil prices and generally commodity prices is likely to be short-lived unless there is the spread to a wider economy. And then at some point in time, the focus will shift to the supply and demand fundamentals. And the supply and demand fundamentals for oil, or let's say for copper, are relatively strong.
Angelina, just to pick up on Karen's point here, one of the issues that I think the market is increasingly focused on is what is the availability of credit going to look like going forward? Could you throw that into the mix for us and perhaps help us understand to what extent that may remove some demand for commodities?
So in terms of the availability for credit, I think it would depend on the fundamentals, on the credit fundamentals of each particular company. What we've seen during the last 5-10 years, and probably since the last crisis, is many commodity producers have deleveraged because they burned their feet in 2016, during the global financial crisis, during 2020. So many of them improved their credit metrics and improved their balance sheets. Quite a few companies are free cash flow positive. It's not only in the oil and gas space, it's also in the metals and mining space. So from this perspective, the companies which have strong balance sheet, they should be able to get to the market and refinance. But the weaker high yield names might be under pressure, especially if they have very high leverage.